And we are back. Welcome to We Talk Money. I'm your host, Chris Dunn, and we got the stock geek himself, Travis. Nikki's out again this week. Man, she's slacking. But in all
No, that
seriousness, we've got a lot to talk about, man. Let's just roll into it. We have got Apple Vision Pro, macro picture with rates shifting. We've got China. We've got real estate versus stocks. We've got some weird stuff happening on X/Twitter and a lot of crypto stuff to jump into. Trev, how's it going, man? What have you been up to? What has been happening so far with earnings, with the macro picture? Where should we start?
Man, there's a lot going on. You didn't even mention earnings season, which in stocks has been consuming all of my time lately. And it's been wild, frankly. There's been some wild news. I mean, just today, ARM is up over 50% in one day. This is a large cap company that just reported earnings last night and is up over 50% today. I mean, it's
What
absolutely
happened?
wild.
What's the story?
They just similar to some of the other AI beneficiaries like NVIDIA, et cetera, ARM is actually guiding above their analyst expectations. They're seeing business really picking up in terms of volume with the AI theme this year. And so, you guide revenues 100 million above what analysts expected, and boom, all of a sudden the market is like bucketing you in the AI theme and your stock's racing to the moon. NVIDIA hitting over 700 this week as well. And it's just been wild to see some of these stocks, SMCI, NVIDIA, you name it. Anybody who's in the heart of the AI theme has just been absolutely going parabolic in the past couple of weeks. And you've got, a lot of people saying, oh, these stocks are overvalued. This is a bubble. This is 1999. But stock market and NVIDIA don't care right now.
Yeah, I mean, we've got, as of right now, the NASDAQ and S&P knocking on new all-time highs, just kind of trucking higher. We also had a short squeeze today and yesterday in Bitcoin. It's funny how fast market sentiment shifts. Basically, what happened was with the ETF approval, we had a little bit of a spike, and then people were like, "Oh, it's sell on the news. This is terrible for Bitcoin." And then basically, we just put in a 38% retracement on Bitcoin's price to the 100-period moving average, high probability bounce area. And then over the past 48 hours, Bitcoin was around the magnet price of 42K. And what I mean by that is 42K has been an over-under price since 2021. And today, actually last night, bulls started to overrun that resistance, which created a little bit of a short squeeze. So yeah, it's interesting to see how, despite the fear-based narratives, markets just keep stepping higher. And even on alts, man, I mean, look at this. In total 3, alts are even getting a little bit of a bounce, and we're having breakouts across everything from some older legacy coins to some newer stuff. So we'll talk about that. But as usual, I like to start by talking about kind of the high level, like 30,000 foot overview. So let's talk about risks, which I know can be, kind of a hard thing to predict, but this is the macro narrative, and everybody became macro experts over the past couple of years as rates went insane. So I want to talk about what's happening there. Also with China, China's been in the news a lot lately. Their markets have taken a big dump, and looks like they're in deflation. I know you and Nikki have written about this and talked about it in the newsletter, but what do people need to know about rates? What is the market forecasting, and what's your take?
Yeah, we had a big Fed meeting last week. It was really interesting. The Fed chair, Jerome Powell, basically came out way more hawkish. It's weird. It's almost like depending on what the stock market does, he comes out with a different tone, at the meeting. Like last fall, if you remember in November, the stock market was partying because, they started to soften their language and they started talking about rate cuts. And here, in this most recent meeting last week, Jerome Powell got hawkish again. And he said, rate cuts in March are not our base case. And they're trying to throw cold water on the idea that there's going to be rate cuts in the near term. So the market went back to repricing that rate cuts aren't going to happen until later in the year. I think right now there's just more than a 50% probability priced in that there's going to be a small 25 basis point rate cut at the May meeting. So I don't think it ultimately really matters if it's in March or May. I do think the Fed is behind the curve once again. I think they should be cutting in little 25 basis point increments already because they need to get ahead and not squash the economy by being too restrictive. But, Powell made some good points. He was on 60 Minutes on Sunday. He said, we want to be measured. We want to make sure that we confirm the trend of disinflation before we start cutting rates. But I would argue that trend has been clear for 6 months. And in fact, the CPI, has been on a cooling trend. You look at real-time measures of inflation, like the Trueflation gauge, that's showing that, according to the Trueflation numbers, we're at under 2% year-over-year inflation. So whether or not you believe that, hey, I'm sure there's things that we could say are not ideal with these measures. But if we look across a broad set of measures, I think we will continue to see over the next couple of months that inflation is cooling.
And
So,
real quick, what is the
yeah.
difference between like the US government reported rate and Trueflation? Because, if you go on Twitter, you would think that we're seeing 20 or 50% inflation numbers. People really just like to lean into that narrative. So why is the quote unquote Trueflation number actually lower than what the government is reporting, around 3.4%?
Yeah, when Trueflation uses a lot of real-time measures. And so one thing that the government data has is a lot of really lagged measures. We've talked about things like the rent measures within CPI, how lagged they are, like 18 months lagged. And actually, there's been some articles out, in mainstream publications just in the past couple of weeks saying that, yeah, actually rent prices are down in a number of cities, and especially things like apartment prices, where a lot of cities actually overbuilt apartments, it looks like, post-pandemic. Now we have rent prices actually coming down in real-time measures, but in the CPI, rent prices are up like 6-7% year over year still. So that number is coming down, but it's so lagged that it's taking a while for it to be reflected in CPI. I've been talking about this for a year, but that's one of the big differences between the official government numbers and say the real-time numbers. And interestingly, the Trueflation, the real-time numbers showed inflation spiking way before it showed up in the CPI. So Trueflation was ahead of the curve when inflation was spiking, and now it's saying that inflation's actually down way more than what the real-time, or way more than what the government measures are saying. So I like the Trueflation measure. It doesn't necessarily matter if it's not affecting Fed policy, and maybe it has its own issues, but it's interesting as yet another piece of data that we can look at to confirm or deny. I would also say, that this whole rate thing is again, I think, a little bit silly if we're so obsessed with what's going to happen in March versus April versus May. Ultimately, I think the Fed will be on a cutting path. And I think maybe that's also what the stock market is saying, because the stock market is still rallying despite the fact that Powell came out more hawkish than expected. So, I think we're still headed in the right direction. And you mentioned that people still are acting like at times, on Twitter or just in real life, as if inflation is printing 20-30%. And that's because, if you look on a cumulative basis since the pandemic, yeah, inflation is up like 20% cumulatively. But of course, we measure the year over year rates in CPI and in Trueflation. And so that number is cooling, but it still means that we're still at a higher plateau than we were 3 years ago. So
Yeah.
we feel the cumulative effects of inflation as consumers, but ultimately from a investor perspective, we care about what's the number trending to, over the next year.
Yeah, I mean, the middle class is obviously getting squeezed. Real life is actually expensive, and a lot of people are feeling it. But I think it is a good thing to kind of point out that rents are down, right? We posted this in the Daily Doe the other day. The national median rent price fell for the third consecutive month in December. So higher supply, more so than low demand, is driving the prices. So I think it was, 2023, the most multifamily units ever in a year were built. So that's good that supply is catching up. And I know, with rates still being high, like a lot of people still can't really afford the house that they want, but I think that is kind of a good sign there. Let's talk about China too, because this has been in the news a lot. And it looks like, if we look at the CSI 300 index, there's a little bit of a capitulation over the past couple of days. And the Chinese stock market is actually at multi-year kind of support right now. So what are they doing to try to manipulate this? What kind of thesis are you thinking about? I was looking at this chart, is like, okay, is this a good dip buy? And you've got a lot of stuff like, Baba and JD, and the other one, PDD, which is, what is that? Is that Temu?
Yeah, they own Temu and Pinduoduo. Yeah, it's actually been one of the only Chinese stock success stories over the past year.
Yeah, where a lot of stuff like Alibaba is at, multi-year kind of lows. This almost looks like an altcoin that's done a full retracement of a bull cycle. But the indices are also looking like they're at major support and maybe a capitulation. Do you think this is the bottom? Do we have more blood to go? What are you thinking about China?
Yeah, I think it's a very interesting setup. We might have a little bit more downside. There might be, a capitulation event where you really get a just nasty, nasty bottoming process, a final sell-off type of deal before it can maybe make a recovery. Couple things that are really interesting that are happening beneath the surface. I mean, sentiment is terrible, whether you're talking about mainland China, where, investors in the Shanghai index, like especially in the small cap index there, very, very bearish, still net sellers of stocks, or even outside of China. You look at these Chinese stocks that are trading in the US that you just mentioned, like Alibaba, JD, hitting multi-year lows, hitting really ridiculously low valuations. Like JD, for instance, is trading at like an enterprise value to free cash flow of like 2x, which is, I mean, that's just an absurd multiple. And you've seen a lot of foreign direct investment dry up. So, Chinese inflows into the Chinese market have dried up, and for good reason. There's been a lot of like trade war issues. There's been worries over what China might do with Taiwan, et cetera. But, that all aside, I look at the sentiment, I look at the positioning. It's extremely, extremely bearish. The same thing happened in 2008, 2009 in the US market. When we had our GFC, the best time to buy stocks for the next decade was late 2008, early 2009. So, we like those situations where you get blood in the street from an investing perspective. It's hard to pick the ultimate bottom, but I am very interested in Chinese trade, and I'll give you a couple of reasons why. The Chinese
Give it to
themselves,
us.
yeah, the Chinese themselves, the government they don't want to see their stock market making new lows daily. And they're basically telling us that they're about to embark on a multi-$100 billion stimulus directly into the financial markets, directly into Chinese stocks. Whether that works on a long-term basis, I don't know. It may fail. But I do think in the short run, absolutely, it can goose stock prices there. And they're basically telling us that that's what they're going to do over the next couple of months. So that's one. I think that's an interesting, potentially short-term flip. And then also what we have is, valuation support on some of these Chinese stocks, and they're actually starting to do capital returns to US investors. This is very, very key. This is actually something that is a big change, because one thing that I've long been worried about with Chinese stocks, including the big ones like Alibaba, JD, et cetera, is that as a US investor, are you ever going to see any of those cash flows? And, historically, they weren't paying dividends. They weren't buying back stock. Alibaba, on their most recent earnings report, just raised their buyback authorization to $25 billion, which is almost 20% of the market cap. So
Wow.
if they actually start utilizing that buyback, and they did utilize the buyback heavily in the back half of 2023, if they really start to goose that buyback in 2024, you've got buying pressure, you've got capital return via the buyback. Alibaba's also paying a dividend now. So I think we start to see more of these large cap Chinese stocks go, in that direction and actually have capital returns. Then you can actually make a case, even as a US based investor, that these things are maybe investable, at least on a short-term basis. So I'm very, very interested, given the extreme bearish sentiment and positioning, plus the capital return, plus the potential stimulus. And maybe it doesn't work. There's always the risk that, geopolitical issues completely tank this trade. So position sizing is very, very key for risk management. But I think it's a very interesting setup.
Well said, man. I've been thinking about also the shift from demand from the US and China. So a couple
Mm.
weeks ago, I wrote about in the Daily Doe kind of my bull case for Mexico, and how, I thought that now is actually a good time to consider Mexico as a rising economy. And we saw a lot of like nearshoring and things like that. But one thing that actually I noticed today, this was published by the Morning Brew. It looks like Mexico has surpassed China as the top exporter to the US for the first time in like 20 years.
Mm.
So my question is like, is this bearish pressure for China, or are we really going to affect their economy that much? Have you thought about that?
Yeah, absolutely. I mean, I think that, the numbers are already reflecting that. If you look at, the Chinese GDP figures, they've slowed down. You look at, the Chinese inflation numbers that we just got, I think today or yesterday, showing that, the Chinese are actually seeing deflation. Unlike the US economy, the Chinese have been seeing deflation broadly over the past year. So yeah, and we've also seen it in the foreign direct investment numbers, things like that, the net trade deficits. Yeah, there's definitely a loss of US based dollars in China. Now, China's been offsetting that because, they're still exporting a ton of goods to other parts of Asia, to Europe. Those are very key trading partners still. So I think China can be fine even with a reduced US-China role. And I think ultimately it's good for the US that we are nearshoring a lot of production to places like Mexico or even back in the US, because we don't need to be so dependent on a country on the other side of the world. So I think ultimately
Absolutely.
these are definitely good things for the US. I think the Chinese economies, we're already seeing the impact of that in the numbers. Probably continues. I think the nearshoring trend is going to intensify over the next couple of years, especially if we get, say, a Trump presidency again. But I do think the Chinese economy, can still grow via its relationships with other parts of the world. So it doesn't have to be a zero sum game,
Hmm.
but yeah, but the Chinese economy is definitely feeling the impact. And, you mentioned Mexico, other parts of South America and Central America are very much bright spots. A lot of people are very optimistic about even places like Argentina and El Salvador, where we've seen political changes that have seemed to have an effect. So definitely a bright spot. We've been looking at some potential stock ideas in some of those countries.
Yeah, man. And I just spent the last month or so in Mexico City, and what an amazing place.
Yeah.
If you are somebody who only watches like mainstream media in the US, you would think that Mexico is just a complete war zone hellhole. But I felt more safe in Mexico City than pretty much any major US city.
Mm.
And there's just so much excitement and so much happening there. I think it's definitely a blind spot that a lot of people have. It wasn't even on my radar until one of our mutual friends mentioned it a couple of years ago that they were going to go get married there. And my initial reaction was, wait, you're going to go get married in Mexico City? Like, isn't that like a cartel hellhole, like super dangerous? And man, how wrong I was.
Yeah. Yeah, it's really interesting. I think narratives that get spun in the media, and of course all the border issues too, have an impact on that. But what's happening at the border is very different, I think, than what's happening in some of the major cities. Yeah.
Yeah, well said. I mean, it's definitely not a utopia. There's definitely a ton of problems, but I don't think there's a utopia anywhere in the world. In the US, we certainly have our fair share of problems. And I
Yeah.
don't know. I just love travel, and I encourage everybody to get out there and just see the world, because it does open your eyes to a lot of things and helps you think more objectively about opportunities. So
Yeah. Well said.
let's talk about the Apple Vision Pro. So this was the huge news over the last week. Um, I think we talked about this a few months when they initially came out with their pricing. I was like, man, 3 or 4 grand, that's too high for your average consumer. But it seems like they've sold over what, 8 or 900,000 of them. And a lot of people seem to love them. So was it 8 or 900 or 200? I don't know. A couple 100,000
Yeah.
units at least, right?
Yeah.
But the price point definitely is a barrier. I've heard rumors, I don't know if this is true or not, that they're going to have an Apple Vision Air that is maybe 1,000 or 1,500 bucks. I've been watching all the review videos that I possibly can, and there's that kind of initial hype that I've seen, that initial excitement, and I definitely see the use cases. What do you think? Are you going to buy one?
Oh man, I know. I've been debating this over and over. The price point is definitely a sticking point. Like, I bought an Oculus pretty early, really was excited about it and blown away by it in the first month. And then like it was gathering dust by like the third month. I just wasn't using it very much. So I was a little concerned that it might be the case with the Apple Vision Pro as well. But yeah, like you said, I mean, I similarly have been seeing just very glowing positive reviews and people saying, actually, wow, this really is exceeding my expectations, and some of the things that we can do with it are very different and cool. So if they do come out with a model at a lower price point, I'm definitely getting it. This one, I might do a wait and see. I might test it out. I'm trying to figure out exactly what the killer use case for me is, and I haven't quite figured that out.
Yeah, I agree. So I initially bought the HTC Vive, which back in like, was it 2015 or 16 was like the best one at that time. And it was super cool. And we had a big office. And so everybody that would come into the office would throw it on and play the games. And it was absolutely like mind blowing at that time. But after a few months, it did end up just like collecting dust. And then a few months ago, I bought the PSVR 2 because I got into like racing and I built this like sim racing gig and or rig, and that was super fun, but that's even tailed off. So for me, it's like, okay, the two use cases that seem like they could be worth it are if it really is like an immersive, like big screen, movie situation, like I can see how that could be fun. But also, like, can it make me productive, like more productive? Like right now, I'm sitting here at a multi screen setup. If I can throw up a bunch of screens and be totally immersed and then just like kind of lose myself in work, if I'm way more productive that way, maybe, but I don't know, like how much time do I really want to spend with that headset on? And also, there's definitely a lot of positive reviews. I want to share like a negative review from somebody. So this is Beeple, the guy that sold the most expensive NFT ever for, what was it, 65 million.
Mm.
And he's actually very bearish on it. He wrote this long Twitter thread talking about how he's a huge, fan of Apple products, but he says, unfortunately, the Apple Vision Pro is not V1 of that future. And he's super disappointed. And I won't read everything, but he says that, he thinks that Meta is more on the right track with their Ray-Bans.
Mm.
Because they're going to be a lot lighter and easier to wear, where nobody's really going to walk around with an AR, headset. So I don't know. Yeah. I mean, we're already seeing people wearing them on airplanes and subways and walking down the street about to get run over. So I don't know. I'm unsure about how much this is going to really affect Apple's revenue. Apple's already not a cheap stock, but I've seen some people like Chris Camillo and some other guys talking about how they think this is going to be the, open up a decade or two of runway for increased sales, where, the iPhone has kind of stalled out. This is going to reinvigorate their sales, and every single person on the planet's going to have one. Do you have any predictions or thoughts about how this could impact Apple's stock price in the next quarter, 2 or 3?
Yeah, I think it's going to be really not that meaningful in the short run, at least on the current run rate. And, as far as could it open up another growth vector for the next decade, I think that's possible for sure. But I think it goes back to what we said earlier. They've got to get to a much lower price point so that they can open up the mass market. The iPhone, the reason, it's such a huge hit is because, almost everyone can afford a phone, even if they have to, pay for it monthly or whatever through their provider. You can make that cost effective given the utility of it. So I think at a $3,500 price point, that is really tough to hit the mass market. But I do think if they can get this price and this form factor right, and within a couple of years, that could open up the market. But I don't think it's going to have that big of an impact on the results relative to expectations for the next couple of quarters.
Yeah, that makes sense. I did think it was a little silly when people are like, I'm getting net long, I'm going crazy just based on future potential sales of this. I don't know if it's going to be that meaningful. I mean, I know that they have sold under $1 billion worth of them so far. I mean, but when you look at like the size of like the AirPods, like that's
Mhm.
larger than most S&P 500 companies, just the sales from that, right? So I don't
Yeah, I
know,
mean,
man. Apple's a
Apple's
beast.
gonna do like 400 billion in annual revenues this year. So, 1 billion isn't gonna move the needle too much. But the idea, the hope, I guess, would be it's 1 billion this year, and then it's 3 billion next year, and then it's 10 billion 2 years from now. We'll
Yeah.
see. I don't think it's the thesis makes sense to buy. I mean, Apple's earnings report was, I would say, relatively a snooze fest.
Yeah.
And they're not growing very fast. In fact, revenues was actually down year over year. But, I think it is a little bit of a transition period. I think once they get some of the AI features into the iPhone, you'll have a new refresh cycle there. Maybe you can get a new version of the Vision Pro that opens up the mass market. You have continued growth in the high margin services side of the business. I mean, Apple's still well positioned, but you want to see some better growth before you buy it at like 30 times earnings. So, yeah.
Absolutely. Absolutely. So one thing I wanted to bring up that we actually just did a class yesterday for the wealth building community talking about my perpetual wealth building machine. And what this
Mm.
is basically a framework that I've been working on for several years that just talks about how I like to build wealth and how I think about the process and how I've built a process, or AKA a machine, that kind of perpetually builds wealth for me. And so I wanted to talk about like just a couple of parts about this, because I know you got into, like a little bit of a back and forth about, is real estate better or are stocks better? And we'll talk about that. But I was this got me thinking about the different asset classes that I look at and how I think about building wealth, and how the ultimate goal for me, and what I think is like probably a common goal, is to create what I call an escape velocity portfolio, which is basically where your portfolio's returns or your gains exceed your dream lifestyle burn. So, let's say your dream lifestyle costs you $500,000 a year, and on average, your portfolio grows at $1 million a year. You have reached escape velocity, because even if you spend all the money it takes to live your dream lifestyle, your portfolio still grows faster than you can burn, right? That's what I think true wealth is where you're not obsessing about, not spending money on coffee or trying to live on an extreme budget, but it's like no matter what you spend, your portfolio grows higher and higher. And of course, we have something called lifestyle creep, which is what a lot of people run into as they start to make more money. They spend more and then they actually never get ahead. They never even have cash flow. I think a lot of people get in that situation. But um, this is something that I've been wanting to do like more training on and do some deep dives. So actually what I'm doing next Tuesday is I'm doing a live class for anybody that wants to join on how to actually build your own perpetual wealth machine. And this is exactly what I did to hit financial freedom by the time I turned 30, and that we've seen a lot of people in the wealth building community be able to achieve. So, quick plug, I'm going to link this up in the description, or you can go to skillincubator.com/live class. So, again, I'll link that up in the podcast and the video. But if you want to learn more about this, I think it's a great idea to come to this class. I'm going to go in detail about the difference between like my active investing and trading portfolio, my passive portfolio, all the different asset classes I'm in, where I put my money, how I create cash flow, stuff like that. But yeah, Trav, anything you want to add to this? I just wanted to kind of bring up this concept and talk about how I think the main goal is that escape velocity portfolio. But another goal that I think is really important to think about as well is focusing on activities that give a high return on time. Basically, like every hour you put into it, how much return are you getting? And an example of like a bad ROT is day trading. Most day traders lose money, and those that spend, 40 hours a day day trading, a lot of them don't even make like a McDonald's salary, where you as like I wouldn't call it a passive investor, but you're like a value investor, longer term positions, like your return on that time that you invest is probably very high. So do you think about that goal, or how do you try to quantify it?
Yeah, no, I love the concepts that you've laid out. When we talk about wealth building in our wealth building community, sometimes it sounds a little bit nebulous, or like, you can't quite get an idea of what that means for like specifics. It's easy to describe like, oh, stock picks or ideas for, what crypto coins people are investing in. We give that too as part of our wealth building community, but there's so many different components of building that full like plan. And it includes things like asset protection and, income sources and active versus passive investing, and all these different concepts that I think that go into it, tax strategies, et cetera. Like there's actually quite a few different areas within this umbrella concept that I think we try to dive into and provide resources for. And so I really like the way you like laid it out, and I think it helps to kind of open people's minds up to the different components of what that what that requires. So yeah, I love the framework. I love the idea of the escape velocity portfolio. I certainly that's certainly been a primary goal of mine as well. And hitting, when you hit that like escape velocity level, it allows you to essentially control your own time, which for me is, I've said over and over, is one of the biggest things for me. One of my biggest goals in life is to be able to dictate my own schedule, to be able to, have my own time to do things when I want to do them. So yeah, when you get to that point, obviously it gives you a level of, not only financial freedom, but also time freedom. So yeah, I love the concepts and the framework you put together. So I think like it's something that absolutely is something that people should tune into.
Yeah.
Yeah.
And I just see people make so many mistakes that like keep them from really having that true financial freedom. It's like people think, well, if I just accumulate Bitcoin or if I just have a cash flowing business that's successful, it's like, yes, those are all very important pieces, but if you forget about things like tax optimization, which is boring as hell, but it's our biggest expense. So you have to think about it, or at least have somebody in your corner that can really guide you in the right way. Or if you're not leveraging, like you said, asset protection things, like there's so many things that can go wrong. So anyway, I'm really excited because we just did a class for the community. I'm going to do one for everybody. And if you want to come to that, again, I'll link this up in the description. But I think no matter if you're an active trader or just a passive investor or a real estate guy, or no matter what you're doing, I think this framework can help you. So definitely come to the class. And that's my pitch.
Well said.
I'm just so excited about it. Like I've been obsessed about this for several years, and I just want to get everybody to look at it. So
Yeah.
all right. With that said, let's talk about Twitter. Elon actually just posted this, or somebody tweeted at Elon, or X posted at him. A lot of people on the left really hate Twitter or X or Elon or all the above, but this week it's been the #1 news app in 163 countries. It's currently at the top spot on free apps on the Apple Store. You posted a chart here that was showing how it's been consistently in like the top 100, but it's been actually kind of eking up over time into the top 60, then 50, then 40, and then boom, it went to the moon. What happened? Why is X so popular this week?
I think there's been some interesting real-time news events, as well as some cultural events that I think have pushed people to X. And there's some speculation about, whether it was the Grammys, or whether it was, Tucker Carlson, or whether it was Drake's, nude photos getting leaked on X. It's probably some combination of all of the above.
Yeah.
But certainly interesting to see that trend, because, I think sometimes those spikes to the #1 app are short-lived, but it is, if you look at the trend line, and that was, I think, US focused, but if you look at that trend line there of the X's overall app store ranking, it has been rising over the past, couple of months. So I think it's a very interesting trend. And, certainly I haven't found an app that gives me better access to real-time information than X, or Twitter, or whatever we're calling it today. It's been true. It's been true for me for the last decade. Like that's where I go if I need to see what's happening, or I need to see, on the ground reports of something happening in sports or some big news event. Like I go to Twitter to see it real time. Like if you're waiting to see it from like a cable news network, it might be a couple hours before they actually get to it, or before they have something useful.
Yeah, I agree with you. I mean, I have so many saved lists and just ways that I use it. Obviously, it's very noisy. It's like a constant waterfall, and I know it's very political, and some people love it, some people hate it, but I get used from it. But you definitely have to control the waterfall flow of information, otherwise it'll just eat up a bunch of time.
Oh, that's well said. Yeah, I find myself getting stuck in Twitter too many times, or like even second screening it at night when I'm watching another show. And it's great. It's great for like me, especially in finance, to like get ideas and see what people are talking about stock wise and things like that. But there's also some real downsides, like you mentioned. You have to be like sort of careful to not let yourself get sucked too deep into whether it's political debates or spending too much time on it. Like any other app, you just don't want to spend your life in that app, especially
Yep.
in certain corners of it. But
Well, speaking of, I mean, you got into a little bit of a debate here. I just wanted to pull this up. So, Levels IO is saying, quote unquote, buying a house is a good investment. But for it to be a good investment, housing needs to be increasingly scarce. less houses per people, higher price, higher return on investment. So you got to choose a house scarce and keep houses scarce and a good investment, or build more houses. And then do you want to like talk about this? Our buddy Sam was responding, and what was his argument and what was your response?
Yeah. So Sam, our buddy Sam was saying, he thinks it's silly to assume housing is a good investment and that, it's a good store of value. He said in most cases, like it really isn't a good investment compared to alternatives. And particularly he thinks that, stocks are the best alternative. And look, I am the stock geek. Like I spent my career focused on stocks, but I think Sam is wrong in this case. Like if he said, well, show me the data. So I actually, within minutes sent him some academic research papers and some charts showing the returns of stocks and real estate over very long time frames across multiple different countries across the world. And what we see is that real estate and stocks actually have pretty similar long-term returns. And so I think we also see that borne out by like the wealth that's been created, particularly in the boomer generation in real estate. I think we've also experienced the frustrations of housing and the amount of time. You mentioned return on time, right? Sometimes if you're actively investing in real estate investments, it's a real pain in the ass, especially if you're a landlord. You got to deal with, tenant issues. You got to deal with maintenance. You got to deal with all these different things. Even as a primary homeowner, you have to deal with those things. I mean, I just got done dealing with an HOA that was like a nightmare for me.
Yeah.
But ultimately that return was still very good, even after all of that. I think I do think stocks are a great asset class for individuals because they're so liquid. You can do it passively. You don't have to deal with as many, day-to-day frustrations. But stock markets also have much more volatile drawdowns. And so sometimes we forget in years like this that, you have 2008s, you have 2020, early 2020s types of moments where the stock market will sell off 30%. So it's not without its issues as well. So I think there's no need to make these mutually exclusive. Like historically, stocks and real estate have beaten inflation over long periods of time. You can invest in both. Most people do invest in both. They've got their primary home that hopefully gains value over time. They got their 401k accounts in the stock market. There's just trade-offs like everything else in the world, in my opinion.
Yeah. Was this data, because when we're looking at these returns, pull this up, it does show like across multiple countries from the 1870s to 2015, the average estimated annual return between stocks and real estate. And in the US, it's showing, basically stocks just barely outperforming housing. Do you know if this is before maintenance costs?
It does include maintenance costs. If you go look at the paper, which is called the rate of return on everything, there
Mhm.
are some slight methodology tweaks you could make and probably change the outcome a little bit here on the data, whether
Mhm.
that's changing the time frame or increasing the amount of maintenance costs. The other thing too is this is a very broad data set. Like if you look at a specific geography, it might be different. Like Detroit has not had probably great real estate returns in the past 2 decades, whereas certain areas of California have way overperformed.
Mhm.
So there's a lot of caveats. The other caveat that I would say is that real estate, it has a lot of embedded leverage. When people are taking on 80% of home value mortgages, effectively what you're doing is you're leveraging your equity, 3 to 4x. And
Right.
so real estate's return, the return on the equity you put in can be quite high, but it also is a big part of that is because there's a lot of leverage on top of it. So you might actually only have, say a 4 to 5% annualized return on the asset itself. And especially once you bake in maintenance costs, maybe it's only 3%. Maybe you only get a 3% return on the asset itself. But when you apply that leverage, the return on your equity could be, 10, 12%. So that's another caveat there is like, when you look at the overall return of the asset, it might not even look that great, but you juice it with leverage, it looks a lot better.
Gotcha. Yeah, that makes a
Yeah.
lot of sense. Yeah, I mean, I've been notorious for kind of crapping on real estate just because my own personal experiences have been not great. I mean, I love to own land with freshwater access, and I like to have nice houses, but I think it's easy to underestimate the cost of certain things. Like, I own property where I have to have a tractor and like do do endless amounts of work, which I enjoy, But yeah, you got to think hard about that return on time, because investing in stocks can be relatively hands off, where real estate, it just comes with a lot of bullshit, man. A lot of variables, a lot of ways to lose money. And you've got to love it to succeed in it, which we both have friends that do, and they work very hard in it. So it's a great asset class if you're willing to do the work, I think.
Yeah. Hey, if you're Billy Murphy, who we had on We Talk Money not too long ago, it might be a very different story, right?
Yeah, the right concentrated bet, boom, one idea leads to generational wealth.
Yeah.
Yeah. I want to talk about some individual assets and look at some crypto plays, talk about some individual stocks. But, for me, again, just kind of doing a crypto run through here. Over the past 48 hours, we saw a little bit of a short squeeze. Like I said, I've been net long since early 2023, had my first buys here on that 20K pullback, and have traded in and out of this, and then recently added on the 33K break, and just been holding. I mean, again, the bull thesis is intact until it's not. And I think getting short Bitcoin, again, this isn't financial advice, but this is just my personal opinion. I think getting short Bitcoin ahead of this train is just very dangerous. And we've seen squeeze after squeeze after squeeze. And even against the NASDAQ, if we look over the past couple of years, Bitcoin and stocks were kind of tracking each other throughout the later part of 2022 into 2023. And then most recently, we've seen Bitcoin picking up strength against stocks, and has recently turned resistance back into support. So that's what we typically see during a halving year. And as of right now, we've got less than 90 days to the halving. So I think there's been some buying in anticipation of that. But we're also seeing, just continued strength among some large caps. I took a little bit of profit on Solana. Wasn't the best fill, but I'm still long looking for like the 150s. And we've even got some newer tickers that are showing relative strength and just continued bull trends. So it's very interesting to see how, even among all the regulatory, pressure and scrutiny and crackdowns, it's like capital is still coming into crypto,
Yeah.
and still obviously coming into stocks. I mean, do you think we're back in like meme coin territory and meme stock territory, or is market sentiment a little more tempered? What are you feeling out there?
It feels a little bit euphoric in pockets of the market. It doesn't quite feel as broadly euphoric as we saw in 2021 during the meme stock craze, or in some other time periods we've experienced where things got really silly. But it is silly in pockets, like I mentioned. In AI themes, particularly Nvidia hitting 700, SMCI. Stocks like that. We've actually seen some pretty big positive moves. Even I mentioned ARM earlier, but even a few other stocks where I thought the earnings results were good, not great. You did see some nice pops on the stocks where it was up 15-20%. So yeah, I think there's definitely some euphoria, particularly among like large cap tech again, and we've seen valuations expand again. We've got tech stocks once again, a handful of them trading at 20-25 times sales, which starts to get to kind of ridiculous levels. So
Yeah.
that does concern me a little bit, but I think we can run a lot further still. And I don't think we've seen a broad euphoria. And there's actually some things I think that are still concerning. I mean, we're seeing some pretty bad price action in regional banks. We had
Oh yeah.
one regional bank in particular last week reported earnings that were worse than expected, and the stock has sold off 50%. So NYCB, New York Community Bank, they were actually the ones who acquired Signature, the crypto-focused bank, last year when Signature went under at the same time as Silicon Valley Bank. And so, New York Community Bank has had a pretty negative price reaction over the past couple of weeks, and that has actually pushed the whole regional banking index and KRE down about 10% over the past 2 weeks. So that's something that could be a problem. One of the things that investors are concerned about with NYCB, they took some higher than expected charges on some of their commercial real estate. So unlike last year, where the banking crisis was mostly due to liquidity issues and deposit flight with the whole bond portfolio issue, the CRE, the commercial real estate issues, are much harder to deal with by the Fed, because the Fed can't just come in and create a BTFP like they did last time, a facility that's going to provide liquidity, and then, oh, the problem's gone. That helped the bond portfolio problem, but there's not a lot of easy ways for the Fed to, fix a multi-year commercial real estate problem, particularly in areas like office real estate, where we're seeing declining values start to impact, some of those assets on the bank balance sheets. And so if that starts to really become a widespread problem, we could have another flare up in the banking system, maybe a loss of confidence, and then, what happens at that point. So I'm not saying that's going to happen. NYCB looks relatively contained right now, and hopefully they can, stave off any potential bank runs. But that is an area of the market I'm keeping a close eye on, because we know how bearish that can be if it turns into a worst case scenario.
Yeah. Well said. So as far as black swan events go, or potential black swans, so regional banks, China, anything else you're thinking about?
There's always the geopolitical issues, right? We got lots of
of course. All the wars happening
elections.
around the world.
Yeah, the wars, the elections, big year for that, huh?
Yeah. Oh my God.
Yeah.
Yeah. I don't know. I don't know what's the best run through here. I'm just gonna hide out at my my ranch over the next several quarters and just buckle down.
Yeah, I'm not looking forward to late Q3, early Q4 election timeframe in the US. That's going to be very unfun.
Yeah. Well, let's focus on what we can control. And there's really three things that I think any of our viewers or subscribers can think about. I asked this actually the other day. I said, what is your biggest financial goal right now? And the three options I gave were destroy debt, or increase income, or optimize investments, which could mean, a variety of things, but it was kind of interesting. Destroy debt was actually a lower percentage than I thought it was going to be. It was about 16 or 17% said they needed to get rid of debt. Number two, or actually the highest one, was increase income at about 40%. And then optimize investments was almost the same at about 38 or 39%. And then we had some other comments like, more Bitcoin, or expanding skills, or financial sovereignty, just a little bit of color on these things. But I thought it was interesting because I think these are really the three major things that people can think about, or that they should be thinking about. Because step one, it's like in this wealth machine that I built, if you have high interest debt that is compounding against you, it can really cause you to stay poor forever. I mean, it's just crazy how much having high interest debt really hinders everything else. So when people ask Nikki, hey, what's the best idea between, paying off debt or investing? I think it all comes down to the interest rate, right? If you have high interest debt, you've got to get rid of that. And then from there, the second big thing that I think a lot of people should put a lot of their focus on is increasing income, right? Do everything you can from the time you wake up to the time you go to sleep to not just increase your income, but increase that cash flow. Because obviously without cash flow, this also suffers. And then from there, once you get to a point where you have no debt, you have cash flow, then that's where the fun part really comes in, which is okay, what do you do with it and how do you grow that wealth?
Yeah, very well said. Very well said. Interesting to think about that math, if you did have credit card debt, for instance, that's accruing at, or, compounding at 25 to 30%, you could be making great returns if you had annualized 15 to 20% returns on your stock portfolio, that's really good, but you're actually going to be falling behind if your credit card debt levels are, compounding at 25 to 30%. So
Yep.
Definitely a good point there about, it's like sort of the flow chart. You got to tackle that problem first, then you tackle this problem, then you tackle that problem. It's sort of and again, another reason why I really like the framework that you put together to help people think about this.
Yeah, thanks, man. Yeah, we'll go into more detail on Tuesday. So again, if you're not subscribed to, or I guess registered for that class, definitely come on Tuesday. It's going to be packed with a ton of value, and I'm just super stoked to do it. So, yeah, anything else you're looking forward to over the next week, TD?
Well, we got some official inflation data coming out next week. That'll be important. We still have a number of companies reporting, although it should start to slow down next week a little bit. But it will still have, some reports to look through and some stocks to watch. Yeah, I mean, that's really it. We've got what else is on deck? I mean, it's crazy. I can't believe it's already, about to be like mid-February.
Yep. It's moving quick.
Yep.
All right. Well, we can go ahead and wrap it up there, guys. Make sure to please leave us a review on your favorite podcasting platform. It really helps us out. We've noticed a lot of people really tuning into the audio podcast, and also make sure to subscribe to the We Talk Money YouTube channel, which is different from me and Travis's and Nikki's channels. So go to wetalkmoney.com/community if you want to check out our wealth building community. And with that said, guys, have a great week, and we will catch you guys next time. See ya.